Hi, good morning, everyone. Welcome to our Phillip Securities Research Weekly Morning Call. Today, we have technical analysis on S&P 500 and Marco Polo Marine, as well as the quick recap of our second quarter US strategy stock picks and event, which will be then followed by Singapore Weekly. Thank you. Jordan, hand over to you.
Thanks, Max, and good morning, everyone. So, like Max mentioned, we'll be running through our second quarter tech strategy and stock picks that we posted last week on Thursday. Next slide, please. So we'll be running through a few sector themes and sector trends that we're seeing right now. The first trend that we're seeing is layoffs piling up. We've been hearing about a lot of tech layoffs over the last several months. This chart is just kind of a recap of what's been going on. You can see that for the first quarter of 2023, there were about 155,000 tech layoffs. If you put this into a little bit of context, when you compare it to the whole of 2022, it's almost the same as compared to the whole year. So you kind of saw this real ramp up in tech layoffs in this past quarter that we just had. Obviously, one of the main reasons for this is dropping margins. This chart, but the orange line in the chart is the operating margins for the FANG M stocks, and I took the FANG M stocks mainly because it is your largest companies, and it's about like 40% of your Nasdaq or your triple Q ETF. So you can see that operating margins have been declining for the last 5 quarters, from 24.5% to about 20%. And the significant tech layoffs should help to at least ease these declines and should help to the margins to actually reverse track and expand again. Just for more context, when you look at a company like Meta, they laid off about 20,000 people. They also eliminated another 5,000 jobs. But this is only about half of what they actually added on in terms of headcount since pre-pandemic. So from about the first quarter of 2020 to the fourth quarter of 2022, so the whole 3 years, they added about 40,000 plus employees. So they really only cut slightly over half of it, and we do think that there is still room for some of these tech companies to lay off more workers, although we don't think that it'll be at the rate of what we just saw in the first quarter of last year. So moving on to the next slide, we do think that the AI boom is well on its way. There's been a lot of chatter about ChatGPT recently and generative AI. So when you look at AI over the last, from 2018 to 2021, global corporate investment actually tripled from about 50 billion in 2018 to about 175 billion in 2021. And we do see that most of this actually comes in the form of M&A as well as private investments. So right now, we do think that this trend will continue moving forward, especially as a lot of corporates, try to leverage on AI capabilities to improve their business workflows and their capabilities. When we just turn to what's the difference between the AI capabilities now as compared to previously. So previously, so how they categorize AI would be traditional AI, and this traditional AI is very predictive in nature. So it's all about recognizing patterns from existing data, and then kind of predicting what's going to be happening next based on this data. Whereas for right now, with generative AI, it's a little bit different. Generative AI is actually able to produce new data based on what's been underlying, and it's a little bit more perceptive. So it's a bit more flexible, it's a bit more fluid, and it gives a wider range of possibilities that I guess they factor in a lot more inputs compared to traditional AI. Next slide, please. So when we look at investments in AI and who stands to benefit from AI, the first kind of a group of customers that you can look at that will benefit would be your SaaS companies, your software as a service companies. So companies like CRM, Adobe, stuff like that. So previously they've always been leveraging on a little bit of older AI technology, which is business intelligence, so BI. And this falls into your traditional AI category. So right now, as they upgrade from BI to AI, or rather to generative AI, they're able to leverage a little bit more in terms of, firstly, on the consumer, the product side. They're able to generate a little bit of a more realistic, a little bit better product. Secondly, on the back end, they're also able to integrate these products a little bit better with other platforms. And so the use cases for a lot of these SaaS companies actually increases. The second beneficiary that we see will be digital advertising, because they'll be able to leverage on generative AI portion of I guess targeted advertising. And it's supposed to help increase the performance of targeted ads and so on, making them a little bit more cost effective and delivering more return to advertisers. The third group of I guess people that definitely stands to benefit will be your semiconductors, mainly because as more and more people rely on AI, the use of AI actually requires a lot of your processing power and stuff like that. So you would expect suppliers of GPUs and CPUs to actually benefit, because they also have to ramp up their supply based on the demand that will be following in the future. So we think that these three groups of customers or suppliers will stand to benefit from AI continuing to boom in the years to come. So moving on to our next sector trend that we're seeing, and that will be on streaming. So we still think that streaming is very strong. It continues to gain popularity throughout the first quarter of last year. Next slide, please. When you look at this chart, it's a chart of the whole US TV market. And you can see the line in blue, which is streaming, started January 2022 at about 29%. Right now it's at 34%. You do see kind of a drop in from November to December, and a big reason is because it wasn't because of a drop in popularity, but actually there was a change in the way that certain forms of streaming was categorized. So it actually got recategorized into the others category, which is not in this chart. But when you look at other types of entertainment like cable and streaming, and cable and broadcast, it's really been declining throughout the whole of last year and still declining into the first quarter of this year. Whereas streaming has continued to gain from strength to strength, and we do think that this will continue moving forward. A big reason is because the content that you're actually able to watch on streaming platforms is getting better and better. These streamers are putting more and more money into producing their own original content. And secondly, watching videos on demand, there's a lot more flexibility. Consumers can watch whatever they want, whenever they want. They can pause it halfway, come back later. And thirdly, it's a little bit more cost effective, and it's built for mobile platforms as well. So when you think about Netflix, for example, your average price is about $12-13 US dollars. But when you think about cable, this number goes into 50s, 60s. So it is a quarter or a fraction of the price of what you would pay for other traditional forms of entertainment like cable or broadcast. The next question that we'll see from the streaming industry would be as to how companies can actually increase their revenue per users. And what we're seeing right now is a lot of these streaming companies are actually going to advertising. So one reasons for this is because advertising is a very high margin business. So they're trying to leverage on streaming plans that have digital ads that come at a cheaper price point to target a lot of consumers that aren't willing to pay such a high price or $12-13 for a Netflix plan, for example. So that's all for my sector trends. I'll pass it on to Max for semicons. Thank you.
Thanks, Jonathan. So I'll give a brief update on what is happening in the semiconductor industry. And you can see, as from the title, we are still in the contraction. Yeah, so this chart is taken from ECIA, and although it says quarter-over-quarter growth, it is actually plotting the year-on-year growth of the trailing 3-month sales in any given month. There are two key messages that we can take from this chart. Firstly is that the semiconductor industry is highly cyclical, and that each cycle lasts for about 48 months. And this is measured as the duration between the upward trend and the and the bottom of the trough of the downward trend of each cycle. So the current cycle that we are in has actually started since the middle of 2019, and we are currently in the downward trend of the cycle that really started into full gear in the second half of last year. Which brings me to my second point. The next thing we would like to note is that majority of the decline in semicon sales right now are dragged down by the steep decline in memory prices. As you can see from the orange line on the chart, memory sales dropped by close to 50% towards the end of last year, whereas the other type of semicons only dropped by about 2 to 3%. And if we combine both of these together, it will result in the blue line, which shows that the semicon sales declined by about 14%. So yeah, from this we can see that the effect of the decline in memory is quite significant, and this is not surprising because memory makes up about 25% of the industry revenue. So yeah, with that in mind, the memory is the main laggard in the industry. So that's a brief update of the semicon industry. Now I'll hand over my time to Ambrish to talk about cloud.
Thank you, Max. So moving on to cloud, next slide, please. We expect it to grow. Cloud, it basically means that you can store and access the information over the internet from anywhere. So you don't need to store it on your local desktop or personal computer. The top three cloud players are Amazon, Microsoft, and Google. And then, so for instance, your Google Drive or Microsoft OneDrive are your cloud service providers, which you can just rent a space from them on a monthly or an annual basis. Just as another example, Netflix, it stores its content on Amazon Web Services, and it does not have its own data center. And as a result, it saves a lot of money by relying on Amazon Web Services for its storage, and it has a global reach, and so it can be easily accessed. So for cloud, we expect public cloud revenues to grow by about 19% CAGR over the next 3 years. And the main growth drivers for this particular sector could be the digital transformation trends by the companies in order to remain competitive. And it could also get a boost by critical artificial intelligence breakthroughs. So that's all for cloud. I would now like to pass on to John for individual stock picks.
Yeah, thanks, Ambrish. So moving into our individual stock picks, I'll just cover, I guess, some of the FANG companies. When you look at the FANG M companies on a whole, in terms of valuations, their forward PE is actually looking quite attractive right now at about 27, 28 times compared to its 10-year historical averages, which are around 32 times. So right now it's about more than one standard, or around one standard deviation below its long-term average. Although it was a little bit lower at about 25 times, you can see in this circle on the right, it's kind of jumped up a little bit, maybe because the prices of a lot of these FANG M stocks have really rallied in the last month or so. Moving on to the individual stocks, I'll cover Alphabet first, and we have the title of this slide would be a recovery in margins. Our three main points would be resilient growth in terms of revenue growth. So we do expect revenue growth to be about 8 to 9% this year, which is down quite a bit from its long-term average. But we do think that given the macro uncertainty over a lot of things, it's still fairly resilient given its multiple levers for growth. We do expect, or rather, we are seeing YouTube Shorts still kind of growing strong. It's showing a lot of strong user engagement with more than 50 billion daily views on its platform. And even though we do see this as a positive for the long term, in the near term, it is actually a little bit of a negative because if you're having more viewers go onto YouTube Shorts away from just normal YouTube, right? And by virtue of short form video platforms that don't really monetize as well as other sorts of I guess longer form video and other sorts of media, this actually puts revenue growth in sort of a headwind, at least until shorts monetization improves because you're just stealing, you're stealing market share away from your own other product, which monetizes a little bit better. So it's a little bit of a give and take, and it's a very good positive for the long term, but in the near term, it is a little bit of a headwind for revenue growth. Secondly, we do expect margins to recover gradually. You can see in this chart, there's a steep drop from 2021 to 2022. Margins dropped by almost 50%, from 30% to 21%. A big reason for this was slowing revenue growth, but expanding expenses. So we do forecast this to actually start to expand a little bit, especially as companies like Alphabet have begun to take on a little bit more cost-cutting measures, be more prudent in their spending, as well as a pickup in revenue growth. So you kind of have this growth on the top line and bottom line as well. In terms of free cash flow generation, the company actually generated about 60 billion in 2022. We do expect this to increase to about 75 billion this year. So that just gives them a little bit more buffer for to actually return value to its investors through share buybacks, because they don't really give dividends. Lastly, we do think that valuations remain fairly attractive right now. So Alphabet's forward PE remains about 18 times, which is almost about one standard deviation below its long-term average. So very similar to the FANG-M chart that was put on just now. We maintain a buy rating on Alphabet with a target price of $131, with a last close price of $108.42. Moving on to my next company will be Meta Platforms. And we have the title of Year of Efficiency, and that's something that the company's actually reiterated over the last couple of earnings calls. Our three main points here, they are on track to improving efficiency. One of the main things that they really did was really spend a lot on hiring over the last several years. You can see in this chart, it's the headcount growth chart versus revenue growth. You can see headcount growth, was still high at about 20%, whereas revenue growth, revenue actually contracted for the last 3 quarters. And the bars in blue are just your total headcount at the end of the quarter. So you can see that, as they start to lay off employees, it should help to at least ease some of the headcount growth, while revenue growth starts to pick up a little bit. And so this should translate into a widening of margins, which is the theme for a lot of your tech companies. When we look at the margin recovery, we do expect some of it to lag a little bit actually for this year. And the main reason for this is because as they start laying off and they start downsizing a lot of their data centers and maybe office facilities, they do actually incur one-off restructuring charges and severance related charges. Just to put in context, they incurred about $4 billion of this in the fourth quarter alone. So for the first quarter that just passed, you would expect something similar. Maybe not as high, because for the first quarter they mainly did a lot of firing as compared to downsizing of office facilities, which they did quite a bit of in the fourth quarter. So we think that recovery will come a little bit more in 2024 as compared to 2023, especially as revenue growth starts to pick up as the digital advertising industry starts to recover as well. And which brings us to our third point, the digital advertising, although rather the weakness in demand for digital advertising is still a headwind in the near term for the company. At the same time, there's a lot of there's very tough competition from companies like TikTok and Alphabet with their YouTube Shorts. So we maintain a neutral rating on Meta Platforms with a target price of $200 US. The last close price was $216.10. So moving on to my last counter, which is Netflix. We do think that for Netflix, we could potentially see the next wave up in terms of earnings. In terms of our three main points, the subscriber base it continues to expand. So actually, Netflix ended the year with about 231 million subscribers. So that brought it. So it increased its subscriber base by about 9 million for the whole year. Although most of this, about almost 8 million, came in the fourth quarter alone, and it's quite significant because there were quite major headwinds for 2022. There were major headwinds in the first half from the Russia-Ukraine war, when Netflix was essentially kicked out of, lost all their Russian users and a portion of their Ukrainian users as well. And this just leads to, it's a testament to the quality of the content that Netflix is actually producing. It shows regularly fill the top 10 weekly streaming charts beating out a lot of its competitors from Disney and HBO and stuff like that. The second point, when we come to margin expansion, when you look at this chart, it basically shows your long-term average revenue per membership, which is your last 12 months average revenue per membership, which is prices, compared to operating margin in the orange line, which has been declining over the last several quarters. The main reason for the decline in operating margins is because Netflix actually has been spending a lot of money in terms of content production. So they've really ramped up the content production. They built up their content library so that they don't have to rely so much on its competitors actually for content. So it used to actually license a lot of its content from Disney and HBO and stuff like that. And so you saw this decline in margins over the last several quarters. But right now, the companies actually mentioned that they kind of have stabilized spending on their content moving forward. So we shouldn't actually see margins decline that much any longer. It should actually reverse and start to expand a little bit moving forward. At the same time, they are starting to leverage on advertising revenue with their ad-supported plan called Basics with Ads. And so as more and more users kind of come onto that plan, which is a little bit cheaper, but way higher in margins, we should see operating margins expand a little bit. The last point, it is also still riding the tailwinds from a streaming market that's gaining popularity, not just in the US but globally as well. And so these tailwinds are actually really strong, and we do think that it will continue to push not just Netflix but other streamers in the industry forward. Kind of as the industry kind of evolves a little bit and Netflix becomes a little bit more mature as a company. So that's all for my counsels. I'll hand it back to Max to cover Apple and Amazon. Thank you.
Yeah, thanks, Jonathan. I'll start off with Apple. The first point for Apple positively is that the Apple managed to increase their market share in the fourth quarter of 2022 with about 35% market share, and it took the share of some of the shares from Samsung actually, which was the leader before then. We think that this was possible because there are more customers in emerging markets that decided to buy iPhones instead of the other cheaper Android alternatives. And this was actually backed by Apple during the latest earnings call, whereby the company said that it has enjoyed consistent double-digit growth in emerging markets, especially in countries like India, Vietnam, as well as Mexico. And then the second point for Apple is that the bright side is still on its services segment, and the services segment has successfully recorded positive year-on-year growth over the last couple of quarters, despite facing a foreign exchange headwind of about 8%. And it is still expected to continue its growth for the current quarter as well. So we like this because services generates a high margin revenue, and this means that any growth in the services revenue should also travel down and increase the net income as well. And then furthermore, we also like the fact that the services segment is continuing it's increasing its contribution towards the company's overall revenue, as we can see from the blue bar at the bottom of the chart. However, for Apple, the near-term headwind is that the demand for smartphones seems to be continuing its decline. And IDC is expecting the total global smartphone shipments to decline by 1% this year. If you would like to say it as the silver lining, is that the decline in Apple shipment is expected not to be as severe as what their Android counterparts are expected to experience. So overall, we still maintain a buy rating on Apple with a target price of $186. Next, moving on to Amazon. The story for Amazon is still the same, whereby the company is still emphasizing on increasing its efficiency. Amazon has embarked on an aggressive cost-cutting measures, which ultimately led to the layoff of 27,000 employees. And we can see that this initiative is bearing its fruit, as we can see from the chart. The average revenue per employee for the fourth quarter of 2022 is about 13% higher than that of the fourth quarter of 2021. Furthermore, in February, Amazon also announced that it will be sourcing its European products directly from brand owners as well as manufacturers instead of going through a middleman, which in their business is the distributors. So we think that both of these factors combined can actually expand their Amazon's overall margins quite meaningfully moving forward. And this is especially true since Europe is Amazon's second largest country outside of the US. Then moving to the second point is that Amazon is expanding its AWS customer base. So in the current environment where all the enterprises are trying to cut down on their operating expenses, well, migrating to the cloud is actually one of the most popular methods of doing so because it is cheaper than maintaining their own physical on-premise data centers. So Amazon has indicated that the AWS new customer pipelines remain strong and that it is in talks with many other companies that are putting plans in place to migrate to the cloud and commit to AWS in the long term. So we like this because AWS is a much higher margin business as well compared to the retail business. And secondly, it's also because AWS revenue is also recurring in nature. However, the main headwind for Amazon is that we are expecting a slower near-term growth and because of two reasons. Firstly, consumers are still hampered with the high inflation, which means that they will be more careful in their discretionary spending, and this will hurt the retail business. And furthermore, the AWS business is also the growth is also expected to decelerate. And this is because the clients are opting for lower cost products. However, we think that the growth is going to reaccelerate in FY24, particularly for AWS, because both the new and existing customers are expected to upgrade their product purchases as they need to scale up the computing demand when the macroeconomic environment improves. So overall, we maintain accumulate on Amazon with a target price of $117. Next is the last counter for me is NVIDIA. So we recently initiated coverage on NVIDIA as well. And the first investment highlights for NVIDIA is that it is the market leader in discrete GPU with 88% and 95% market share in PC and data center segment. So the leadership comes from the fact that it possesses superior product performance as it powers about 70% of the world's top 500 supercomputers. And then it also developed the programming language CUDA, which acts as a strong mode because it is widely adopted by developers worldwide, and it runs solely on NVIDIA GPUs, which practically locks them into the platform. And then secondly is that NVIDIA's data center segment has been experiencing a strong growth momentum. And we are expecting this to continue moving forward as well. As you can see from the chart, the data center revenue in the blue bar has quintupled from 3 billion in FY20 to 15 billion in FY23. And FY23, it actually overtook the gaming business as the largest business for NVIDIA. So we think that the growth trajectory will continue to moving forward because there's increasing demand for AI in data centers because enterprises are trying to integrate AI into their operations. And furthermore, the versatility and capability of generative AI, as evidenced by ChatGPT, should also act as a tailwind because it coincides with the launch of NVIDIA's next generation data center GPU and CPU. However, the risk for NVIDIA is the US-China tension. So China makes up about 20% of NVIDIA's total revenue, which means that it is quite a significant chunk of the business. And therefore, any escalating tension between the two countries, or if there's any further export bans of the company's advanced chips to China, this will impact NVIDIA's ability to continue selling their products to the Chinese customers. So overall, we maintain our buy rating or NVIDIA with a target price of $315. That will be all for me. Now I'll hand over my time to Ambrish to talk about Microsoft. Thank you.
Thank you, Max. So moving on to Microsoft, we believe that there are two main growth drivers for the company, and namely its cloud service Azure as well as its productivity software Office 365. So if you look at the left-hand side chart, productivity and cloud, both these segments, they contribute about 75% of its total revenue. So moving on to our thesis, Azure cloud momentum is still strong. So Azure, it's the second largest cloud provider globally, and it has a market share of about 22%, and it has doubled its share over the last 5 years. So we believe that Azure, it should continue to gain market share, mainly because as the companies, they digitize operations, and Azure as well, Azure's integration capabilities with Office 365, and the management, it claims that Microsoft's Azure's pricing is almost 5 times lower as compared to the Amazon Web Services. So as the cloud sales they increase, it will also increase Microsoft's profitability, mainly because they are high margin business. So for the third quarter of 2023, Microsoft, it anticipates Azure's revenue to grow, still grow by about 30% despite the slowdown. So moving on to our second thesis, demand for Office 365 remains strong. So Microsoft, it also has the dominant leadership in the productivity, global productivity market share, about 90% of the market share. So this includes its Teams and the Word, Excel, PowerPoint softwares. So the main growth drivers for this segment are that as the economy reopens and as the companies, as the employees, they start going to office, more number of users could be using Office 365, mainly to manage the rising need and tasks for their workflows. However, in terms of risks, we believe that in the near term, Microsoft Windows OEM revenue could be hurt, mainly because of slowdown in personal computer sales. So Windows OEM revenue, it basically implies the revenue that it generates from PC manufacturers like Dell and HP, mainly because they install Windows software on their machines. So overall, we have a buy recommendation on Microsoft with a target price of $298. So moving on to my next stock pick. Next slide, please. Airbnb. So Airbnb, we believe that the travel demand should continue this year. And if you look at the left-hand side chart, last year, the booking volumes, they surpassed its pre-pandemic levels. And we anticipate the volumes to further grow by about 20% over the next 2 years, mainly because of recovery in urban and cross-border travel, as the COVID-19 restrictions, they have eased. And also the long-term stays, like about the stays of over 28 days, they have also remained resilient, mainly because of flexibility due to remote work. So Airbnb, it also has recorded a unique highest listings of about 6 million as of December. And it continues to innovate its product, it released a flexible search feature, as well as insurance coverage to hosts and travelers. So these additional features, innovations, it could help Airbnb to increase its booking volumes. So moving on to our second thesis, Airbnb, it reported a maiden net profit last year of 2 billion, and the profitability is expected to continue mainly because of higher top line growth, revenue growth, as the volumes have increased, and also because of high operating leverage. So in terms of risks for Airbnb, in FY23, its daily rates, they could be under pressure, mainly because of a business mix shift towards regions that have lower average daily rates, like the Asia Pacific regions. And also it's a consumer discretionary spending. So due to the high inflation and rising rates, the consumer traveler spending, it might impact Airbnb's top line performance. So overall, we still believe that Airbnb, it's well positioned as it can benefit from rising demand for alternative accommodations, as well as due to recovery in travel and its a unique supply base. So overall, we have accumulate recommendation with a target price of $149. So next slide, please. So moving on to PayPal. PayPal, it's a digital payments company and it has a global presence of over 200 countries. And we believe that its main advantage is its two-sided network. And this is mainly because its user base, it serves both customers and merchants, and it serves like about 400 million customers as they can transfer money to other family and friends who are PayPal users, as well as to pay for goods and services. Whereas it also has a 35 million merchant profile on its platform, where they can receive money for the goods that they have sold. So moving to our thesis for PayPal, customer engagement, it continues to climb. So if we look at the leftmost chart, the number of payment transactions per user, it has increased from about like 40 to about 50, to nearly 50 in FY22, and it's expected to continue to rise. This is mainly because the company, it now has shifted its focus to generate more revenue from its existing customers, and it's not looking forward to add new additional users by spending on advertising, mainly because the more it believes that the more it engages its existing customers, it would benefit from that. So the one way the company is doing this is that it is trying to monetize its digital wallet platform Venmo. So it has been added as a payment service on Amazon. So as its adoption increases, as more number of users they pay through the Venmo on Amazon, its PayPal would benefit as its payment volume would increase. So moving to our second thesis, PayPal, it's focused on improving profitability. So last year in FY22, in second half of 2022, it reduced its OPEX by 900 million, and it further anticipates to reduce its OPEX in FY23 by about $1.9 billion. And this is through layoffs as well as through real estate consolidation. However, in terms of risks, PayPal, it's witnessing a slowdown in its total payment volume growth. So in FY20 and FY2021, the payment volumes surged drastically, mainly because of COVID, as more number of people, they were at home, and e-commerce transactions, they increased. So, however, it's expected to grow by about 10% over the next 2 years. And overall, we believe that PayPal, it should continue to benefit in the long term as a secular shift to cashless payments, as well as the e-commerce trends it grows. PayPal would be benefiting from that. So overall, we have a buy recommendation with a target price of $103. So that's all for our recap for the strategy and stock pick events from last week. I would now like to pass on to Zain for technical analysis.
Thanks, Amrish. So now I'll go through the technical portion. Next slide. Also for S&P 500, we actually found support upon a retest of the 4,080 level. So this level was a previous swing high back in early March this year. So the previous resistance now turned into a support. Then last week we found resistance at around 4,130, which was a retest of the uptrend support line in the chart. For now, we are still trading above the breakout of the broadening wedge, as well as still within the uptrend channel currently. So not much changes to the trend for now. So the resistance is currently at 4,130 to about 4,200, while the support is likely to be at around 4,000 to 4,080. Next slide. For individual stock, there's Marco Polo Marine. So for this, we have a technical buy at 4.5 cents. The take profit can be set at 5.7 cents. The stop loss at 4.2 cents, and the stop loss goes at 4.3 cents on Thursday. So for Marco Polo Marine, we see a potential continuation of the recent bullish momentum as it actually broke out of this consolidation triangle in the chart to actually to actually maybe reach a resistance at maybe 5.7 cents. So this level, right, is actually confluent with the uptrend channel resistance, as well as when you take the consolidation triangle height, it's around 1.3 cents. So when you take a breakout projection, when you project it onto the breakout level of 4.4 cents, is tally with the 5.7 cents level as well. So we could potentially see price move on to this level in the midterm. Yeah. So that's all from me for the technicals. I'll pass my time to Paul to talk about Singapore weekly.
Yeah, so thanks, Zane. So next slide. So as usual, we'll just run through some of the key macro news in Singapore and especially in the US. So let's start off with Singapore. So in general, there's been positive news in Singapore. So for our retail sales, it was up 12% year on year, but of course, this is affected by Chinese New Year because Chinese New Year last year was in January, and this Chinese New Year last year was in February, and then this year's in January. So that's why the February numbers is strong. So what we do usually is we will take the January and February numbers combined to get a better reflection. So what you see is year to date 23, retail sales is still up in Singapore 6.2%. This is still strong because pre-pandemic retail sales in Singapore was, I think, it usually grows about 0.7%. Restaurants, supermarkets are still weak, it's down 3%, but most of the spending for retail is going to restaurants. You can see from here, apparel, and somehow, of course, watches. I guess people decide not to buy some watches. Watches is down. It's been actually very strong the last few months. So for arrivals into Singapore, also another positive macro news is that in March, for the first time, arrivals into Singapore exceeded 1 million. Of course, year on year is some ridiculous numbers, like 13 times year on year higher, but it is still 65% of pre-pandemic. So what we are missing is still, of course, the Chinese tourists. The first month since we crossed 1 million, and this is the highest, I guess, since the pandemic has happened. Property price remains robust, maybe a bit too robust. So property price in the first quarter was up 3% quarter on quarter. Most of it is coming from RCR because mass market is where the growth is. But when you measure it on a 12-month basis, property price is a bit worrying because it's climbing a bit too fast. It's up about 11%. As we highlighted before, and as most real estate agents will mention, is that they usually get worried when property price over the 12-month period goes into double digit. So the last time we had a cooling measure where the authorities raised TDSR and raised the TDSR limit and also the ABSD was in December 2021. And even then they raised it when property price was only up about 10.6. So now we're trending at 11. And also over 2 years, property prices are already up 20%. So it's something to be a bit more wary of whether there could be some cooling measure, especially if the following quarter is still strong. Then I think it's like almost a done deal. There'll be some cooling measure. We also had some headline jobs number in the US, about 236. It is slowing down the jobs growth. It's still a very positive number, but it's definitely slowing down. So it's the lowest growth since pandemic. And what we see is that the goods sector is starting to shed jobs. So this is important news metric because everyone is just trying to position for the Fed pivot rally, i.e. basically when the Fed pauses. There was some comments by the FOMC which we thought was interesting. That's to give everyone a layout how the Federal Reserve looks at interest rates. I thought she summarized it pretty well. So what she's trying to say is that they want to keep interest rates high a bit longer and then just hold it there. And it doesn't mean that they will only cut rates when inflation hit 2%, because right now inflation is about 4%. What they want is if they can see a sustained downward path to 2%. Of course, nobody knows what is the meaning of sustained downward path and how to measure it, but there is at least if they see some strong momentum that inflation is coming down, then they will pause. So it doesn't mean you have to wait until inflation 2%, then the Fed say, no, you will stop raising rates. So their forecast is this much by year end, and it's only by 2025 that's when they think inflation hits the target. So it doesn't mean you have to wait until 2025 before they kind of cut rates or lower it. But we think with the upcoming US CPI number on the 12th of April, there could be a tradable Fed. Now this is like 99% guesswork here, but we think there could be some tradable Fed pivot rally because we think the inflation will continue to decelerate sharply because one metric that can be used, I mean, it's not the only metric, there are many, but one of the real time is gasoline price. So gasoline price in the US has for the first time contracted very sharply. So it could be one, CPI is also include energy. So it was down about 20% year on year because this is after the Ukraine war spike. And then with slower jobs and declining inflation, so there could be, all this is like narrative. The narrative for the market would change, that maybe the Fed will pivot and there could be a rally, which, we're not sure about, but this is a possibility after the CPI number. The other thing is, of course, with the strong retail and hospital and arrivals, then the backdrop will be positive for REITs like in the hospitality and retail REITs. So in terms of we give you this so that we don't just talk about the macro and what's the relevance of it. So the relevance is that it should benefit the hospitality and retail REITs. The rest is just some of the events. We have Emperador results coming up too, then FOMC meeting. The main one will be 12th of April, the US inflation. MAS will also discuss about the monetary policy. We will show you one chart, the confusing one. Then I think end of this week, you're going to have the US banks starting to release results. For our webinars, this week we don't have any webinars. We will have one Mind Champs, so you are interested. If you want to know more about Mind Champs, we have one coming up, and Sabana REIT, and so forth. Yeah. Next slide. Oh yeah, sorry. The webinar is open to anyone. You can just go to the link to our Poems web page under the education and just register there. So okay, so this is I know there's a lot of words here, but let me just guide you. So this is the property price index. So what we are looking at is the pre-cooling rally. I'm not sure if you can see it, but sorry if it's a bit the color a bit like. But what we want to know is how much did the property price rally before the authorities came up with cooling measure. So in July 2018, when the authorities raised the ABSD for cooling measures, the property price rose about 9.1%. Then in December 21, the property price run about 10.6. So this time around, we're already running at 11. So again, we're not saying there's going to be cooling measure, but we just say that the risk will be elevated, especially if you're going to get another strong quarter in the second quarter. And over 20, because they look at it long term, so 20% over 2 years might be a bit of I'm not sure if it looks a bit strong here. Next slide. Okay, these are the most confusing chart you're ever going to see, but because this is how the MAS conducts their monetary policy. So let me just guide you. This is just for information. It's not going to impact equity markets. I think equity markets won't be affected so much by the exchange rate. But so MAS doesn't increase interest rates or lower. They will normally just move the exchange rate. So the blue line is the NEER. So this is a nominal effect. This is just a fancy word to say that this is the exchange rate of Singapore dollar against the trading partners. Can be ringgit, can be RMB, can be US dollar, and the major trading partners we have like Euro and so forth, or even Australia, which is probably not much, but so you can see the MAS policy is usually in the increase slightly. That means that it's not shaded column. So normally that is the monetary policy for MAS. Then when the economy is not strong, then they will have zero appreciation, the light green but blue. Then when the economy is very strong or inflation is happening, then you get the light blue bar that you see right now on the far right. So this is where we are now. So the authorities for the past three meetings have conducted their monetary policy called recenter upwards. Means you gap up, maybe like any share price, the share price $1, then you gap up to 110. So it's very aggressive by MAS. So over the last 12 months, the NEER or the exchange rate against the basket in blue line is up 6%. So you can see it's one of the strongest. So whenever there's a blue bar, the blue column, the dark blue line will spike up. So what we think the next policy meeting, which is coming up in April, I think coming up this week, we think they will just move into this increase slightly. That means they'll just go to their normal policy of raising the Singapore exchange rate gently. That means maybe 1-2% a year against for the NEER, which is what they do historically. Again, this is just for information. I need to know, doesn't really matter. But I guess just if you want to see, if newspaper comes out, you want to understand, then this is just for reference. Next slide. Okay, so this is just to show the US jobs data. So when we track it we see that wage growth is slowing in the US. And on the right-hand side, so how to read this table is the 236 is 1,000 is the jobs that increase for the month of March. So all the newspapers will have 236,000, but if you break it down, most of it comes from services, and quite a lot of it comes from leisure and hospitality. And then the 2019 average is the monthly average for 2019, that means pre-pandemic. So what we're just trying to say right now is that the goods sector is starting to lose jobs, manufacturing or that, and so in conclusion, we think the jobs market there are some cracks in the job market. So you're starting to see the goods sector start to shed jobs compared to the pre-pandemic, where they typically grow their jobs about 7,000 a month. Next slide. Oh, okay, yeah, this is just a slide on all. I mean, yeah, not that we are all experts, obviously, but we just take the data and we just show you. So, so all prices spiked up after the Saudi raised the production, cut their production quota by 1.16 million barrels, I think. Yeah, but one plus. So we normally just look at. So the table on the left is just to show the crude oil price. So whenever crude oil comes down, usually inventory is rising. So this is the inverse chart. So when the blue line goes down, means inventory is increasing. So it does show that the picture isn't so great. I mean, there's a bit of too much inventory. But on the right-hand side, so obviously, if for Saudi, they should always be worried about the shale producers, because if they cut, then shale could come in and take market share. So it also implies that they don't seem to be afraid of the shale producers. And one possibility, again, we are not all experts, but one possibility is the chart on the right. So this is inventory drill. So this is shale producers, they drill. It's like inventory, that means they drill, but they haven't produced anything yet. So you can see since the last few years, it continues to dwindle. So it might mean, it might mean that shale production is hitting some limit because there isn't enough inventory, or they might be, most of the money goes to share buybacks. I don't think they're interested to drill anymore, drill that much. So we think oil price should stay elevated because there's this thing called the Saudi put for now. So why we say is for now is because if demand doesn't come back up, this so-called cut in capacity should also be like a hidden supply. That means there's excess capacity on the side, which the market might read it negatively. But on balance, because oil price, there's always like five things that could be good for the oil price, and then 5 things that could be negatives. But right now, we think with the Saudi put, with the US also not haven't filled up their strategic reserves, and with China reopening, all this will, and the low capex, of course, this is a structural thing, should still keep oil price elevated. The only thing that could pressure it is, of course, the whole weak global growth. I mean, if US go to recession, then that will affect. But the interesting thing is that they're cutting production just before the US driving season. So May and June could, it'll be interesting of the driving season whether they could actually push oil prices up. But again, we are not all experts, but we just share whatever we can, because we always seem to get questions on it, and it will affect, of course, some of the stocks here like San Marino. Next slide. Okay, so this is my last one. Again, this is just for reference, because we get questions like, do you think there'll be a rate cut? So based on the current inflation number, again, this is just mathematics, this is not forecast. So based on the most recent February inflation, inflation could hit by December only 3.9. So this is below the Fed's forecast of 3.6. So what we're just trying to say is that inflation isn't trending down trending down fast enough to hit the target. So this may mean the Fed may not even pivot or may not even cut rates, but we need to watch the data. So this was only March. So February, we think March could see inflation coming down steeper. So if that happens, then we will update the chart, and we might then, trend line wise, it could already kind of hit below the Fed. Then there's very good chance the Fed will pivot or even cut to a certain extent. Yeah. The green line is just the 3-month average. So what we do is we take the month-on-month for February, and then we just extrapolate it until December to get 3.9. Then we just take the 3-month month-on-month average, which is higher at 0.4. Then we just extrapolate. The problem for that is actually climbing up instead of going down. But we will see how the March number and April number comes to get a sense of where inflation is trending. So this is not forecast. No, this is just mathematics. Yeah. I think that's it for me. I think we can move on to question answer.
Hello. Yeah, there are two questions from. One of it is prime US REIT has been removed from your absolute 10. This was your topic in the REIT sector. Has the fundamentals changed and will you continue to cover this counter? Yes, yes. One thing for sure is that we will continue to cover this counter, but has the fundamentals changed? The fundamental hasn't really changed much since the last FY. But the thing is, because there are a lot of US commercial, the a lot of negative sentiment, a lot of some analysts coming out saying that there's a lot of doom and glooming crisis or whatever coming going forward. And then the meme lord Elon Musk himself also came out to say to tweet last week that there's some issues in the US commercial sector. I mean, Elon Musk, when he tweets something, he can really move the market. So a lot of this is kind of a negative sentiment. But fundamentally, the issue with the US commercial space is mainly in LA, downtown LA. A lot of the cities like the red states where like Texas and where the Republicans are is not so bad, the commercial, as compared to some of the gateway cities, especially LA. Yeah, so we'll continue to cover the counter, and prime is still fundamentals hasn't changed much, but there are some headwinds for sure. It's not all rosy for prime as well. It is now a PTP security. Prime has been a PTP security all the while actually. It's just that they have some exemptions together with the other three Singapore listed US REITs. So they are exempted from the 10% withholding tax. So they are not affected by that. Yeah, and do you think there's an impact on the reserve winners? Yeah, so the PTP doesn't really impact them because they are exempted from the 10% withholding tax. Yeah, so that's for prime. Then there's another question, similar question. Morgan Stanley issued warning on US commercial REITs due to rising interest rate and refinancing risk. What are the implications on S REITs like Capital, Oak Prime, Manulife, and how would it impact the confidence of the investors of the other Singapore listed office players? Yeah, so Morgan Stanley they issued a report, and then their issue is saying that more than 50% of the $2.9 trillion in commercial mortgages will be up for refinancing, and that is more than the 5-year period average. And then the issue is that, of course, the rising interest rate like more than doubled. So they're saying that the refinancing of these loans is going to be an issue. But if you go specifically into the US office listed REITs, I don't think that they are that much impacted by the refinancing of these REITs. The refinancing of their loans. I don't think they're that impacted because their gearing is also still. I mean, apart from Manulife, since the valuation declined, the gearing of the other two REITs are still in around 40, if I remember correctly. So it's not too bad. So, and of course, you have to look at where their assets are. Manulife has one big asset in LA, which saw a huge 33% valuation decline, while the other prime and core, they are not so much in. They don't have assets in the LA. Yeah, so and then how it will impact the confidence of investors for the other office players in Singapore. Yeah, so they are not very affected by this US commercial this US commercial headlines. The main thing is because like the work from home phenomena for the US, they are now looking at like three-day work week. So they're about 60% back to office. But for a lot of the Singapore players and Singapore commercial space, especially in the town area, CBD area, a lot of them are like full or at most 80% back to office really. So they're not very affected. And because of the limited supply as well in Singapore, I mean, towards the end of the year, there is one big release in the IOS Central Boulevard Towers, but other than that, it's still, the supply is still quite tight. So the Singapore office space is not that negatively affected as compared to the US commercial space, which is mainly the gateway and LA side. Yeah, so we do see some refinancing risk, especially since a lot of them back then, like maybe 2 years back, like we see Brookfield, when they picked up their loans, right, a lot of it was on floating rate. So when the rates increased like by 4%, And then because their assets is in LA, which is quite a weak city for vacancy. So their vacancies in the LA was quite high also. So because of that, the rental they got was lower and they had to pay higher interest. So which is why a lot of like profile they defaulted on their loans. So yeah, that is the issue there. Yeah, I think that's all the questions for me. I hand over time to the rest of my colleagues. Thanks.
Can the US team take some of the questions?
Yeah, I'll take some of the questions first. So there's this one question. Based on data, how long will the semicon lull time needed to get it run out for overall period and counting from now? So yeah, just now I mentioned that on average historically the cycle lasts for about 48 months. So currently we are in month 39 and month 4 or month 40. So if we take the historical pattern as a benchmark, we can expect the semicon to start to recover by the end of this year. So in about 9 months' time. And yeah, this is roughly in line with what the executives of semicon companies has guided. So for example, like Nvidia, they are saying that the inventory channels has corrected, so they're expecting for quarter-on-quarter revenue growth moving forward as well. So yeah, hopefully that answers your question. Then I think there's one more for me. Oh yeah, how is the demand for iPhone falling, but they are taking market share from Samsung at the same time? So yeah, the market share, iPhone lead the market share in fourth quarter of last year, and this is because I guess the decline for iPhone shipment is not as significant and as the decline in Samsung or in fact Xiaomi as well. So furthermore, in the fourth quarter, it's also the period of the iPhone 14 launch. So that also boosts the shipments they also boosted the demand for the iPhones as well, which resulted in the increase in the market share. Yeah, I think that's all for me at the moment. Now I hand over my time back to the rest of my colleagues. Thanks.
Thank you, Max. So there was one question with respect to cloud. What proportion of the current cloud market is attributable to the US? So so in FY23, about 50% of the overall global market size is expected to come from US, which is about like $250 billion US dollars. And the next question was, which are the largest cloud players in China? So in China, the three largest cloud players are Alibaba Cloud, Tencent Cloud, and Huawei Cloud, and they have a market share of about 70% in China. So there was another question with respect to PayPal. What is your assessment of PayPal versus MasterCard and Visa? So basically, PayPal, it's a growth story. It's a growth story, and it's still expanding its merchant adoption. So it's still looking forward to adopt for increasing its adoption of merchants. Whereas MasterCard and Visa, they are payment processing for credit cards. So they are they are well established, but now they are looking forward to expand their verticals into B2B. So yeah, so that's all for me. I would now like to pass on to the rest of my team.
Okay. Let's try. Let me try to answer something. We can just go all to the technicals. What do you think of CDL fundamentally and technically, which Zain will do? Then what do you think of Tembusu Grand? So the Tembusu Grand sale was, of course, very good news. I think the expectations for prices was about 2.3 to 2.5. I think they hit the high end and they sold out 50%. So I think it's very good news for CDL. And because the expectations also maybe sell through rate for this year, maybe 30%. So to hit 50 is actually a very good number. I'm just saying again, whatever we share is just what I guess what the market or agencies were thinking about. Fundamentally, we still like CDL because they like I said, they have a property development pipeline, and number two, they have a base of hospitality assets. The only thing is that again, we're really not sure just whether there'll be any cooling measure. Hopefully not, but that would be the only thing that could maybe just dampen the price. But these are the two reasons why we like CDL, because it's trading below our RNAV. Our target price is 8 something, and also they have a hospitality. So there's two earnings driver for them. Yeah. Okay, sorry for the audio earlier, not sure why. What's driving up Southern Alliance fundamentally and technically? Okay, so the iron ore market is expected to be weak. So I mean, we are not iron ore specialists, but we just share with you what the expectations is. Firstly, it's all about property market and construction activity in China, which doesn't seem to be performing or fixed asset investments in China, which isn't growing as much as expected. Then number two, in China, there are plans to centralize iron ore procurement. So that is also another worry that investors have. And there's apparently announcements to kind of cut steel production, which, because they rely on iron ore. So the outlook isn't very strong for iron ore, so fundamentally. And also, if iron ore was performing well, then Southern Alliance peer Fortress Minerals should also be rising. I think the Fortress Minerals share price hardly move. Of course, it doesn't help they're going to do that. They are planning to do a placement, which they announced. So we think the only logical thing is that in the Southern Alliance reply to SGX, they did, I wouldn't say hint, they just say that M&A is always there, just that there's nothing material. So they didn't say there was no M&A discussion, they just said that it's not material. Again, not to put words in their mouth, but I'm just reading off what they said. So the only possibility is that there could be some M&A angle, which we are not clear with, just reading off from the announcement. But on the iron ore sector itself, it shouldn't be, otherwise Fortress should also be climbing up strongly. Likewise for iron ore prices. So it's nothing to do, we think, about iron ore prices. Yeah. Okay, the next one, Singtel deal in Indonesia. Yeah, the deal is good because broadband. Okay, so for the deal, for those who do not know, so Singtel has a mobile arm called Telkomsel, which they earn about 35%. Then now this entity, Telkomsel, the largest mobile operator in Indonesia, has bought into the largest broadband operator, which is also part of the Indonesian Telkom group. They are the party that owns the remaining 65% of Telkomsel. So we don't have the valuations and so forth here, but it's going to be it's a good acquisition in the sense that IndiHome, which is the broadband in Indonesia, has about 75% market share of broadband. I mean, basically, is the leader, the most dominant player. So we are positive. The only anomaly which I need to double check the company is that when they increase the stake by 0.5% in Telkomsel, they paid 236 million. So if you do the maths backwards, I have to double check my number. It implies that Telkomsel valuation is 40 billion, which obviously is not, but that's something which we need to clarify with them, because the valuation, the implied valuation for Telkomsel is just a bit too high. But it is a very good deal because you do not want them to be indirectly some competitor or so forth. But it's definitely, because broadband is the fastest, is going to be fastest growing. I think that they announced the penetration in Indonesia is only like mid-teens compared to ASEAN. Most countries are 40%, and they are the market leader. So it's a high growth area, but so it's definitely a good acquisition for them. High oil price, short-term shock or long-term impact to inflation? Oh yeah. It's a short-term shock. I mean, yeah. But I won't think it's a short. Okay, so the question is, will higher oil price be a short-term or long-term impact to inflation? I think it will be more short-term, because longer term, I think the market is going to look for alternatives. I mean, this is my own kind of guess answer to this. Why Southern Alliance up? Not sure why, but I mean, like we mentioned earlier, why Southern Alliance? So that's our own guess. But oil price is something to watch. If oil price hard, like we mentioned, no, sorry to keep repeating, but it is something to either you hedge it out or you just have to monitor it closely. Because if oil price hit 150, then inflation is going to run wild in the US. The interest rates will also run wild to ad infinitum, that means into infinity and beyond and beyond. And then the whole market is going to call it crash. I mean, not crash, but it's going to get really tough for the whole market if they're going to raise rates further from here. Yeah, so all is something to watch and could also be a way to maybe hedge it out a little bit, I guess. Will the cut in oil supply by OPEC have a positive impact on China aviation or earnings? Yep. I think the impact so the question is, will the high oil price impact China aviation earnings? I think the impact isn't material. More material is whether the oil price curve is contango or backwardation. Sorry if not, may not understand, but contango means the forward prices are higher. That means, the example, 1 year the oil price can be $150, then currently is $80. That kind of conduct. This extreme, but not extreme, just to explain the situation. So for that, it benefits China aviation because they have storage. So they can actually keep the oil and earn the spread on the storage because they have storage in Korea and so forth. But in general, it doesn't really impact them that much if oil price is up or down, because they are the most important is the volume for their for the Shanghai Pudong terminal. So for China aviation, for those who don't know, most of their profits come from Shanghai Pudong, the jet refueling. Petrol pump is a petrol pump in Shanghai Pudong. So that is a fixed markup. So that more important is the volume rather than the price. Of course, price will have an impact because it might just draw down a more inventory for them, because you got to store the oil, there's working capital. So the indirect negative is maybe you need more working capital for them, but volume is the biggest driver. Is there a chance of Sam Marine being included in STI component as its market cap? I think there's a good chance, I guess. Yeah, because the float is very high, which is also a negative because, right, Peggy, I think like 25 billion shares coming from Capricorn. So the good of it is that they got a free float that increase their chance of STI, but the bad of it is there's a lot of shares out there at 12 cents. But it's definitely, I think, if you, sorry, Peggy, you want to go ahead?
Yeah, the market cap is about 8.2 B right now. So it beats about 12 stocks on the STI currently. Of course, the smallest on the STI right now is SETS. So if they were to go in, SETS will have to be out. But then again, Sam Marine is still loss making. I'm not sure whether they will include a stock in the STI while they're still not making money. Of course, if you're already in there and then you start to turn in losses, they can't stop you. But if you are a loss-making company, I think not likely they will be included until they turn into a profit.
Yeah, the smallest is Emperador. I mean, based on weight, which I mean they won't take up. But I think SETS market cap is only 4 billion. It's probably the because DFI, I'm not sure they want to take. Yeah.
Yeah, SETS is now 3.1 billion market cap.
Yeah, so probably the one that has a chance, because it's not just the float of the market cap. So DFI, although their weight in the index is very low, but the market cap is huge. So that's why they might not want to take up.
Yeah.
Okay. Okay, there's this DB. You want to take this one, Peggy, the DBS outage news? Yeah.
Okay. The last two incidents that happened a few years back.
Sorry, just for the benefit, even the question. Sorry, Peggy.
Okay, I read the questions. Okay, this question is, what's the latest on DBS outage news, and has stock drop caused management lost confidence? Just a recap. The last two rounds when they had similar problems, the MAS actually imposed a so-called penalty, but actually is to require them to set aside more provisions in their books. That means put aside resources for that they cannot use in their balance sheet. So technically, there's like no physical penalty being paid out by the banks. So similarly, this time round, the market also expect this similar type of reaction from MAS. So we don't think that should have a very meaningful impact on the earnings of the company. Yeah, but has the stock dropped? I think it's the price has fallen because of another issue about TPS being investigated for not very clear what happened there, but got to do is some I think I better not speculate just in case it's not out in the market. Yeah, but in any case, we find that the current price right now looks like an attractive level, given that it's still trading come dividend. Thank you. Okay, can I go on? Paul? I think
Yeah, sure.
there's
Please go ahead, Peggy. Yeah,
there's what's the outlook on Asonic and BRC? I think can you do Asonic BRC? Okay. BRC, as you know, as we all are aware, since September last year, the authorities came in to implement more safety measures on the construction sites because of the very high number of casualties. So work on the construction site has been very slow. These safety measures will only be lifted by end of May. On top of that, the authorities is rushing out all the building contracts, building projects, PTO and so on. So these are the last stages of construction where you use very little steel bars, rebars specifically for them. So therefore, the volume is we expect to be slow, and also the inventory was sitting in the book might still remain quite high. So therefore, for this coming quarterly results, we don't expect any positive surprises. And just for record, rebars prices have fallen like 10.9% since beginning of March. But in line with what Paul has just mentioned, the iron ore prices were down, and still rebars prices are now back to December 2002 levels. So therefore, nothing much to expect from BRC in the short term. And another news is that HG Metal, if you track that, as she so the majority shareholders have already changed hands into another PRC buyer, and this PRC buyer could have some steel connection back into China. So therefore, HG Metal could become a more formidable competitor to BRC. So all these are things that we will watch out for in the coming 6 to 12 months. Okay, thank you. Okay, back to you, Paul.
Okay. For Asonic, so for those who don't know, they are a freight forwarding company. So there are two parts of the business, just to say in very layman terms. One is container, so they will help other freight forwarders because they can be a wholesaler of containers. So they will book a huge slot in the container, then all the other smaller freight forwarders will tap on them. Likewise, they can also do freight forwarding. You want to ship something from Singapore to US, they will do custom clearance, they will do freight, they will handle everything for this corporate company. But because of the way trade has dropped off, so they are impacted in the near term because I think we've shown before, the volumes, US imports are down 30% year on year. So business in general for cargo, even for sets, everyone, I think Peggy has mentioned before also. So cargo is weak. So cargo is having a major drag on all transportation sectors. So you just have to wait until year end before you see any possible recovery for not only them but the whole sector, for whole transportation relying on cargo goods. Okay, let me just move on. Any investment, Mary, on Topgolf and Riverstone? It's still going to be tough for rubber glove makers. Not as bad, because I think Riverstone is probably the only profitable glove maker out there that is listed. So, okay, let me explain the situation. So the situation right now is still a lot of supply. So Topglove is running at, and this is the largest glove maker in the world, and they're running at 30 to 40% market operating capacity. And even that also they're still losing. So even if demand comes up, they got so much capacity. I mean, the fact that they are only running at 30 means they have a lot of excess capacity out there. So I think it will take some time. The problem right now is that compared to the last cycle, you don't have the Chinese. So China manufacturers are selling at, I think, $16, $17 per 1,000 glove. Pre-pandemic, it was used to be $20. So the Chinese is a new it's a new competitor that the Malaysian manufacturers have never appeared before. So again, let me just quote Top Glove what they said. No, in the past, Top Gloves always said that China manufacturers didn't have the volume. Then later on, China didn't have the quality. Then I think in the latest briefing, he said we cannot compete against China anymore. So anyway, so the thing is that China has become a formidable competitor. So it will take time for this demand supply situation to iron out. So I mean, Top Glove is probably the second quarter of losses. So it's going to be a bit challenging. Riverstone will do better because they're still selling gloves at, I think, $100. I mean, I just told you like $16, but they're still selling gloves at $100 because they are selling it to the electronic, because they are own branded. So because they sell their own branded gloves, they can make the margin when, and because they're selling it to semiconductor industry, which probably didn't really care about the price, but that is what is helping them draw these margins. Of course, you'll be saying why Top Glove don't sell branded, because it takes too much work. You want to sell branded, you need a sales team, you need a warehouse, you need to promote the brand. You take like years, but Riverstone did that painful journey, so they managed to build a brand around it. But Top Glove, I mean, you don't blame them, because Top Glove just fight on volume and price, and they're the largest, so it's just a different model. Okay, let me quickly run through if any more. What's your view on gold? Again, like we mentioned before, we prefer bond ETFs. So because if you think there's a recession, then interest rates down, then we thought that would be the better, more direct way, like TL. Sorry, keep on talking about this, or like TLT and so forth. Of course, the other thing also, we had questions like money market. So money market fund is good, but the only risk for money market fund is that it doesn't catch duration. So if interest rate is going to drop, then eventually your money market fund rates will also go down. So when you buy a REIT or whatever, you at least catch a longer duration. I mean, you catch an asset that has a longer returning yield for you, because you know that things are coming down. Whereas if you do a money market fund, right, it's very short-term rates. But of course, the good thing for money market fund is that it's liquid, and you can come in with, if the market drop, you can come in for opportunistic acquisitions, I guess. Okay, well, this kind of, yeah, sorry, Peggy, can you go ahead? Yeah.
Sorry, Paul, can I jump in? Yeah, sorry. This he pointed out that today EPS is trading ex dividend. Yeah, thanks very much for pointing that out. There's 92 cents dividend that's gone ex effective today. Therefore, the price has also fallen by $1. Yeah, thanks very much for highlighting this.
Okay, are you able to provide some heads up for coming years? Sorry, man, I'm probably give you very bad advice, but I don't think it would be anything bullish. Because I think most of the banks are going to sound cautious. So even though the results might be a little bit better than expected, because last year's results was very poor, because the prior year, 2021, there was a lot of provision write-backs. So then this year, when provisions normalized, then the earnings didn't look good headline-wise. But I think this year you will still see growth in net interest margins, like all the Singapore banks. They rely a lot on investment banking, not like the Singapore banks. So that might be flat, but because last year was really very bad, so we think the earnings might be like a low single-digit thing. But we worry more is just the guidance they might give, because I mean, it'd be a bit strange for the banks to guide very strong earnings. Yeah, they'll probably they'll probably guide the market very cautiously on what they think the outlook. Yeah. Because I guess there's no reward now to be so brave and say that we're going to guide strong loans growth, strong earnings growth. I think they might get sold down instead. Again, this is just my guess. I mean, I'm not the US banking analyst here, so this is just my thing. How does MAS use NEL to adjust interest rates, since they don't? Yeah, this is a good, it's an interesting thing. I mean, officially they don't, but I think probably unofficially there is some intervention by them. But again, I'm really not sure. Sorry for that. I haven't really read up any of the MAS papers to see. I mean, if anyone in the attendees have a better answer. Yeah. For me, I don't think so. They do, but officially they don't. I think. Yeah. Sorry for that. Haven't read up that part yet. Yeah. Why did the price of the? Oh, I think you got it. Oh, because why did the price of US oil climb when inventory climbed in the ground? Oh, the inventory is the other way around. I'm not sure if someone can go back to that slide. So the inventory is actually the other way around. we inverted the inventory so that it kind of synchronized with the thing. So you notice that the blue line, when the inventory rises, that means it's go down, right? Which is a bit unusual, but no, we just wanted to make the chart move along with each other. Sorry for the confusion. So when the inventory goes down, you look on the left, inventory goes up, sorry, the blue line, because the number is inverted. So the 250, 350, it actually rises when it goes down. Yeah, we just wanted to make the chart move along. Yeah. But you're right, I mean, it should be the opposite, just that the inversion of the chart make it confusing, maybe. Yeah. Your view on crude palm oil, yeah, sorry, I don't really have a strong palm oil view, sorry, yeah. But it seems to be most trading sideways than anything else. Because of the high inflation, emerging markets still haven't coped well with the recent jump in crude oil prices, yeah. Because of the inflation, right? Yeah. Sorry, I don't really have a very good answer for that. Yeah. What's the latest situation for those smaller banks, the likes of? I think it has what's the latest situation requirement for those smaller US banks, the likes of? Sorry, I'm not very sure what that actually meant, but based on the latest data, they are still taking funds from the Federal Reserve. I think 160 billion, but that is starting to trend off. Yeah. Sorry, I didn't really understand the question. Hi, I didn't receive the presentation slides after filling. Yeah, okay. Oh yeah. I'm not sure. I need to check. Yeah, can you send us an email? Yeah. The question is, I didn't receive the presentation slides for SG Market Outlook because we don't really we're not in charge of that part, our marketing. But you send me an email, I'll let them. Yeah, maybe you filled the survey form with too many negative things. No, I'm just kidding. Yeah, but you send it to us, a good or negative, we'll definitely send you the Outlook slides. Yeah. Is it possible to have a webinar with Fraser Hospitality over their plan? Oh yeah, we will try. We will try. Yeah, you give us feedback through this Q&A, then we will try to ask them, because sometimes we're not sure what attendees want. So if you send us, we will try our best. We'll just send an email and whether they want to reply. Not sure. Will there be a chance of Japan Central Bank raising interest rate this year after the appointment? Oh, this is a tough one. This is the widow maker question. I don't think so, but I really do not know. I mean, I haven't really done enough work to give a good answer for that. Yeah. But I don't think they will appoint him if he's going to change things. Yeah. Again, I'm sorry, I don't really have an answer for that. But yeah. Is there a correlation between palm oil price and oil prices? Yeah, I haven't done the work. Sorry for that. I need to check. I really haven't done the work. The indirect correlation is because if all, then they might use more biodiesel in Indonesia, not in Europe, because Europe is going to eventually ban that part. I haven't done. Let us do a chart and see if there's a correlation. So I never really done that part because we don't have a palm oil analyst. Only me, I'm the part-time palm oil analyst. Okay. Okay. Yeah. Hi Paul, is the Fed printing more money due to SVB crisis? Would you be bullish in the? Are they printing more money? I'm not sure. Okay, so we have to differentiate. You know, money supply depends on banks lending money. So the printing of money that I'm sorry to, it's a bit confusing. Most of the QE that you see actually went to bank reserves. That means the Federal Reserve will buy. Let's say JP Morgan, they got too much deposits. They will take all the bonds. They'll sell it to the Fed. The Fed will give them cash, and they will just do nothing with it. They just leave it in the bank. That's why a lot of the money that you see is actually all stuck with the banks. But only last year when there was a lot more money, more lending and so forth, that's where you really see the real printing of money. And also, of course, the government gave everyone a few $1,000s. Of course, that will be where the money supply. So we don't think they are going to print more money. The actually money supply might contract because the banks aren't lending. So actually it could be the reverse. Yeah. So when the Fed print money, it may not actually go to the economy. That means it will just go to the JP Morgan. They just keep in the safe deposit box and do nothing with it. Of course, it's not safe deposit box. It's a reserve that they keep with the Federal Reserve, or they put in or is it reverse repo? Or that's not them. Yeah, but they might just park it in the Federal Reserve. Yeah. So we don't think it's bullish. Actually, it's going to be bearish right now because the banks are all going to pull back credit. Okay, I think I have to oh, okay, sorry, this one, like US interest rate up, why US dollar down? Oh, okay. Okay, this is my last one. So it is not just the interest rate up, it is also other countries. So I don't have a chart. Next time we'll do one. If you look at the US interest rates versus euro versus what, actually it used to be very wide because the US was the only one raising rates, whereas euro was, I don't know, the European banks wasn't raising rates, but now the gap between Europe and the rest of the world with the US is also narrowing a lot. And it's not about just the raising rates. If they actually cut rates, then the interest rate differential will narrow even more, and that makes the US dollar, on the interest rate differential, not as attractive. So it doesn't mean just they raised last time then, but it's also you have to compare with the rest. Bank of England also raised, ECB also raised a lot more also, I think. Yeah, sorry. Yeah. So it's not just what look at the US dollar, because currency is all about relative currency, not relative. Yeah. With tourist arrival climbing, what company will benefit? All the a lot. I think many companies will benefit. To what extent? Of course, the hospitality will benefit. Genting will benefit. Even ComfortDelGro. Please don't ask me any more questions on ComfortDelGro, but ComfortDelGro also benefit because the taxi, can pick passengers from the airport, which is the most lucrative route. Yeah. Retail will also benefit, like Paragon or the Orchard. So, but the biggest will be the hospitality. And of course, if they ever listed Changi, which they never will, then Changi will be the biggest beneficiary. But of course, they will never do that. Yeah. Okay. Yep. Thanks. Can we include monthly upcoming ex-dividend lists? Okay. Because the problem with doing that. Okay. Can you include monthly upcoming ex-dividend lists for the SG equities in future? Yeah. The problem is there's a lot. There's just so many coming ex-dividend, like 700, right? And they all like to do December, and then probably like 300-400 every week. So we might do for the index component or maybe the top 20. Otherwise, it's just too many. Like the whole list, the Excel sheet, you probably can't see anything on the slide. But let us see how to do a better way to try to fix that part. Okay, I think I need to go. I'll hand it over to you, Zain. Yeah. One for your question.
Thanks, Paul. So let me just share my screen right now for TA. Okay. Okay, let me begin. The first one is Genting Sing. For example, Genting still very strong. We're just currently just sideways at around the $1.18 to $1.19 resistance. So this was a previous, looking back in history, right? This was a previous resistance back then over here back in 2018. So the next level for Genting, if it continues to break this resistance, right, is around this next level, which is around 121 to about 123 over here. Yeah, so there is the next resistance to look out for. For the current support wise, it looks like buys still around $1.17. If we go lower than that, then I think we might be filling this gap maybe near 112 to 113 over here. And next is China Aviation. China Aviation is quite good. Recently, it broke out of a downwards channel over here. The near-term resistance, I would say, is probably maybe a retest of this previous uptrend support line that was being broken, and then this previous range support over here. So that will probably be around close to the $1, around $1.02 to about $1.06 over here. Then for current support wise, I think we are holding above this breakout line. Will probably be around the 96.5 cents level over here. Next one is BRC. BRC recently had a bit of weakness. So we have come to this level where was a previous resistance around 167, and it managed to turn the support over here. And then currently we are bouncing up a little. Resistance is quite near around 177, which was a previous resistance over here. And then further resistance upwards will be around 180 over here. These are the key horizontal levels to take note of. And for support wise, I think if we continue to pull back, the first level will be a retest of 167 near 167 over here. The next level downwards will probably be around 161 over here, the next horizontal support. Then I think you can take reference from this uptrend line support over here as well. So this was from April 2020. You can draw over here. It comes, if it backtest over here, there might be some support over here as well in this region. Okay, for CDL, EA, let's see. CDL currently, I think still currently in this like flat consolidation for now. So unless we manage to break upwards, then that might be more bullish. But for now, just more of a consolidation. Current resistance maybe around around this close to 750 over here, then maybe stretch to about 760s, close to 770, which was a previous swing low support, now turn resistance. Support wise, I think for now will be around this $7.30 level over here. But if it breaks down, we could be looking closer to maybe $7, which is a main uptrend channel support over here. Yeah. So this was since 2020. Okay, then I'll move on to some of the Hong Kong counters. Okay, for this 3032 Hang Seng Investment Management Tech ETF, currently I think we are testing not much action currently, just sideways for now mostly. This was after we hit the resistance around 422 over here. So over here's the current resistance 422, then this next level around 432, then followed by around close to 440 over here, which was a previous support. Then for now, support wise, I think it's around probably could be around this 415, then followed by $4.05 over here. Yeah, so just sideways for now mostly. And next one is 10 cent. And for 10 cent, also just some form of consolidation for now. We see the small body candlesticks and then the volume just tapering off after this strong move over here. So say for now, support probably be this recent swing lows around maybe 382. Going lower, you might see maybe 375, which was a previous resistance that we took up over here. And for current resistance, probably be from about 390 to about 397 over here. So I'll expect more range movement for now. For JD, we broke out of a downtrend channel over here, but we saw some resistance upon the closing of this gap around 176 over here. Currently pulling back a little. Let's see whether this previous resistance over here, previous resistance around 150, 159, this level, would turn into support with this hammer. We need to see some follow through. If not, we might see maybe a bit more pullback to maybe test closer to maybe 150 over here, the next support level. And for resistance wise, currently it's around 165 over here upwards. And next one is Ping An. Ping An, I think we might be forming a bullish descending wedge pattern over here. We haven't broken out for now. Currently just a lot of sideways trading. So the support for now is maybe around $50 over here. Then resistance probably around this level, around $53 over here, still remaining the same as the past few weeks. Yeah. Okay, then I move on to the three local banks. First one is DBS. the chart is a bit skewed because of the XD today. So based on that, we are below this like trend support line. So for now, the support could be coming. We might do a retest of the previous support that came in. So it's around 3170 to about 3230 over here. So we can see previously back in August to October last year, there was some support over here. Then during the sell down, we tested these levels. So if it hit a bit lower, we might come back to these levels for now. Then for now, the resistance is probably around 3290 over here to over here, which was a level that swing low that we broke down off today because of the XD. The next one is OCBC. OCBC, I think currently we might be wedging upwards. See that price is currently price action is currently tightening in possible wedge. So for now, resistance could be near around 1280 to about 1290. So this level, you see previous resistance over here back in February to start of March this year. Then we could possibly retest this trend line that we broke down off. So over here, there might be some resistance coming soon. Then for support wise, I think could be maybe from about 1260 to about around 1260 over here with this previous swing high. And then we have this current short-term uptrend support line over here. So over here is as a confluence of two supports for OCBC. Then for UOB, I think currently we still see some more of a sideways action. So resistance is still around the $30.20 level, the horizontal level. Going upwards, the next resistance level could be around $30.50 over here. Then followed by around close to the $31 mark over here. And then for support wise, I will take it as the range. Currently, this range support over here around 2970 level. And then going lower, we might see maybe 2920. So that's all. Currently, just doing nothing much for UOB. Southern Alliance technicals. Southern Alliance, I think, not sure why. It looks a bit random because over here we can see like not much volume, and suddenly the volume just came in. Similar to last time, over here we had volume spike, and suddenly we just so currently looks like we are just having some action. So let's see, the next resistance level could be around 98 cents to about $1. So if it continues to go up, then we might come back to retest a previous resistance around, this was in August 2021. So over here, we can see some significant resistance over here at 98 cents to $1. Then support wise, I think for now, if it retraces back, then maybe close to 88 cents might be a support. So this was a previous range support over here before we broke down. Yeah. But take note, this stock, the volume is actually quite low. So even with the volume spikes, we see is around less than 600,000. So if you are interested in trading, just take note of the low liquidity. Then over here last time, back in March last year, you can see with the volume spike, and suddenly you can just die off over here. So that's something to take note. So that's the possible risk. Yeah. Okay, next one is Samudera for short term and long term. I think short term wise, we actually break out of this downtrend resistance line, but currently we are facing some resistance from a previous this range level. So over here we range and support around 131, 132. Currently seeing some short-term resistance for now. So I will expect maybe we face some resistance currently and probably some sideways direction. The strong support may be a retest of these sweeping lows around maybe 125 over here. And then followed by 119, which is this leg, which has held twice last time previously. Then for long-term wise, I think zooming out, we can see it's still a bit high. Long-term wise, you might be looking about maybe a retest of 119, which was a previous resistance, turn into a support over here. Then if you are aiming lower, then maybe you can take reference from this even lower uptrend support line over here. But it's unlikely to be hit in the near term, just a more long-term perspective. Yeah. Then along the ways, you have previous resistance over here around $1.10 and $1 over here as well. Yeah. There's a question on the trading volume of Marco Polo. It's rather low. You want to buy the stock, but it's worried you might be stuck and not be able to profit. Not enough buyers. I think it's still okay. Over here, we can see the good thing is that we have consistent trading range. So there's no like weird gaps that's taking place. And then the volume every day, there's a few millions, I guess. So even on the usual days without the volume spike, you can see it's maybe like at least maybe 5 to 10 million on average. So I think it's still enough to trade, I guess. Yeah. Maybe compared to some of the more like illiquid counters. But it's just your personal preference. If you are worried about the trading volume, then maybe better not to touch it. Yeah. Okay, on First Resources. Okay, First Resources look like it's looking a bit good for now. Actually, outside of this downwards channel over here, then we had some sort of sideways movement last week, and as well as a retest. Then we find some support, quite strong support, few days at around 156 to 157. Currently, we are spiking up a little bit today. So I would think that the near-term resistance is around maybe 164 to 166, these recent swing high levels. Yeah. Then going further up, we might see maybe resistance. I see maybe resistance of this trend line over here. So that might bring us to maybe close to 171, which is also a previous resistance back in November last year. So still looking good for now, as long as these sideways lows are being held, right? As well as we are still above this downtrend channel, is still pretty okay for now. The next one then is Bumi Tama. Bumi Tama also recently we had some spikes. First level of resistance is today at around 64.5 cents level over here. So over here you can see it's quite a strong resistance past few times. And moving upwards, the next strong resistance might be closer to maybe 66.5 cents to about 67 cents, which was also this previous strong support, then we turn into a resistance twice over here. So that's something to take note. Then for support wise, I think currently is around 62.5 cents, which is the opening price, and to about 63 cents, which was a previous resistance over here. Okay, then let's find the Sam Marine. Sam Marine, I think short term wise is still okay. We actually broke out of a downtrend resistance line. Currently looks like a bit of pullback has taking place. Then we also broke down below this 12.1 cents immediate support level. So I think for now, if we can't hold above 12 cents, which is also another this horizontal level, we might see a little bit more deeper pullback to maybe closer to about 11.5 cents to about around this area, which was a previous support. Then we turn to resistance and then acted as support as well. So we might be seeing a little bit of a back test over here for now if we are seeing a bit of pullback. But overall, the trend over here, you can see this stretch. We are just slowly grinding upwards. So it's a more gentle uptrend over here. And then Food Empire. Food Empire, I think we are quite strong. So we actually broke above previous high around 93.5 cents. Then we are above this uptrend channel as well. Currently just consolidating over here. Looks like a possible bullish flag. So if we manage to break above $1.05, we might see more upside to come. Then current support is around this $1 mark over here. So let's see what happens over here. If we break down, we might retest this channel, which might bring us to maybe 96 to about 97 cents. If you go upwards breakout, we might see a range of maybe 5 cents to might bring us to about $1.10 based on the range over here. Yeah. Next one, MedTech. MedTech, I think currently we are possibly retesting previous resistance level near 19.2 cents level. So over here, it was a previous key horizontal level over here. You can see previous support, then a breakdown in the resistance. This was back in October last year. Then in January this year, there was also resistance over here. So this is a level to take note. Further resistance upwards probably be near the 20-cent mark. Then going higher up, the key one is around 21.5 cents, which was the peak for twice recently. Support wise, I would think maybe currently is around 18.2 cents based on the horizontal levels. Yeah. And if we manage to stay above this previous uptrend support line for now around 18 cents, that will be strong as well. Yeah. So these are the current support levels for MedTech, I think. Next one is the top graph. Top graph also pretty strong. Today we actually broke out of like a ascending triangle pattern. So I would think that the immediate resistance is probably around 34 cents, which was a previous swing high back in July last year. Then going upwards, the next key resistance with a few tests last time was around 36 cents. So that's the next level to take note. Then current support, if wise, I think will be around 31.5 cents to about 32 cents over here if you do a retest over time. Yeah. The next one is Hang Seng ETF. So this one also just sideways for now. The current support we can see is around 69 cents. Then resistance is still at around 70.5 cents to 71 cents over here. And so if we break above this, we could see maybe the next resistance level being at near 73 cents. But if we break below this level, we might see a lower support around 67 cents. So currently just some consolidation taking place for the next direction. This one, EEM. EEM looking not at we actually broke out this downtrend channel pullback, staying above this previous support resistance around 327, 328. So we could see a little bit more upside to AEM if it continues to climb. Then the next resistance level probably I would think is around maybe close to 340 to 343. So this was a previous next swing high over here, previous support that we broke down off over here. So it's a key horizontal level to look out for. Then current support will just be this horizontal level, probably around 327 over here. And next one, UMS. Okay, UMS looking good as well. So still above this downtrend channel breakout. So the current support I would say is around this 108, 109 level. Resistance will be around 112 to 113. Currently looks like a bit of a sideways, might be just a little bit of sideways pattern for now since we have small body candlesticks. Yeah, for now. If we do break out the next level, resistance level, thing will be around 115 to 116. We can see this was a previous key support over here, then break down, turn into resistance. So this will be a key level to take note. What's the TA outlook on A-Sonic? I think A-Sonic is rather illiquid, quite a lot of gaps also. But from a long-term perspective, I say currently maybe at this trend line near the trend line support over here. So we saw a few times the price has actually respected this support quite well. So this is around 49 cents around here. And I would think that short-term resistance based on the recent highs would be around 53.5 cents to about 54.5 cents over here. Then cover Riverstone, EA, Riverstone. Looks like we are trying to enter back into this previous uptrend channel that we broke down off over here. But I would think for now, there's some short-term resistance, possibly around 64 cents to about 66.5 cents. So this was a prior resistance level, resistance zone over here as well. So something to take note over here. Yeah. Then, yeah. So this for Riverstone for now. I would think that support wise, probably around 60 to about 60.5 cents this level over here, which was a support over here just in February this year. Next one, Capital Corp. Capital Corp, we are trading above this long-term resistance trend line. So for now, looks like we are at all-time high. So resistance-wise, I can't really tell you about that. But support-wise, if we see a pullback-wise, the first level will be a retest of this swing high around 580. If you go a little bit deeper, then we might see maybe close to maybe 570 over here. Okay, then UOL. UOL with the near-term resistance might be quite near, around maybe close to this close to maybe 720, which was based on this swing high previously. And then there's this longer term wise, there's this trend line resistance acting on it. So around here, we might see some resistance soon. Yeah. And then support wise, I think we might be looking at around 690 to about $7 over here for now. For Hopper, I think let's see whether this we can maintain above this 980 mark. So this was our previous resistance, then unfortunately didn't turn the support. It broke down, retest, we found resistance over here. Currently there was a period above it, then we did a retest. So this is a key level that we see that the bulls and bears are still fighting at this level. So if you can stay above, we could look at more possible upside ahead to possibly around close to the $10 level for now. $10 to about 10.25. Yeah. But if we continue break down, we might see retest of the lower support levels around 960 previously over here. And this one is a Hong Kong land. So Hong Kong land still holding up. Well, after we had the breakout of this downtrend resistance line, we have this uptrend support line that's holding it. So support wise, I would think is around close to 427 over here for now. Resistance wise, we might be looking at around close to 445 to about 450s over here recently. Then DFI. DFI, we have this we might see some resistance coming soon. So previous resistance over here around $3, then became a support. Then there was also previous support over here that we broke down. So around $3 to about close to $3.10 over here, you might see some short-term resistance for now, yeah, for DFI. Okay, then for 2801, recently looks like we tested the resistance around 1260 over here. Then currently pulling back, but still holding above, still holding based on this trendline support. So these holds we might have another shot at this resistance. Then if we do break out, the next level could be looking at previous support or maybe 12, close to 12, 20, 21, 22, 20 over here. Yeah. Then if we do break down, then the next strong support probably be around this horizontal level around $20, close to $20, 30 cents to 40 cents region. Okay, I think it's close to 1, so I think that's all for me for TA. Yeah, feel free to post the remaining questions that you have in the poems technical analysis community group. So I think for now, I just hand over back the time to my colleagues.
Thanks, Zane. Yeah, I guess it's about 1 o'clock. It's about time to wrap up this webinar. Apologies if we haven't really managed to answer your questions, all your questions. Feel free to post it in the P3 community group, and we'll try to get it out there as soon as possible. Do also look out for a report that's coming out at 3 p.m. That will be written by Zane. I think it might be quite interesting to some of our viewers. So with that, just like thank you all for spending your morning, your lunch hour with us. I look forward to seeing you in our weekly webinar next week. And also, if you're interested in just to reiterate, if you're interested in the MindChamps webinar, feel free to sign up and tune in. So with that, I would just like to say thanks and see you all next week. Bye-bye.